All right, today we are diving deep into one of the most fascinating and frankly controversial takes on U.S. tax law out there. We're going to break down an argument, one pulled directly from some detailed legal analysis that really challenges the fundamental way most of us think about our paychecks and what counts as income.
Okay, so here's how we're going to tackle this. This is our roadmap. First, we'll get a handle on a core tax concept called cost basis. Then, we'll look at a golden rule from the Supreme Court. From there, we'll jump into the really big idea: labor as property. We'll see what the source suggests as a strategy, and then we'll wrap up by looking at why this whole thing so often lands people in court.
So, first things first, we have to start with the absolute foundation of all of this. It's a concept called cost basis. Honestly, if you own anything of value, you should know what this is, because it's the bedrock for figuring out what part of your money is actually taxable.
So, what exactly is it? Well, the source material we're looking at defines basis as your total investment in a piece of property. Think of it as the system's way of making sure you're not getting taxed on getting your own money back. You're only supposed to be taxed on the profit, the gain you make on top of that initial investment.
And figuring it out is usually pretty simple. You start with what you paid for it, you add in the cost of any major upgrades that made it more valuable, and if it's a business asset, you subtract any depreciation you've claimed. What you're left with is your adjusted basis. That's the magic number when it's time to sell.
This bike example makes it all crystal clear. Let's say you buy a bike for $100. You put another $20 into new parts. Your basis is now $120. Now, if you sell that bike for $150, your taxable gain is just $30. The key here, the whole point, is that the government can't legally tax you on the return of your original capital, that first $120.
Okay, so now let's build on that. Let's see how this idea of basis connects to a huge legal principle that is the absolute cornerstone of this entire argument. And we're not talking about some obscure tax code regulation here. This comes straight from the top, from the Supreme Court.
And this quote just nails it. We're talking about a landmark case from way back in 1920, Asner v. Macomber. The Supreme Court defined income, and look at the key word they used: gain. Income isn't just money changing hands. According to the highest court, it has to be a gain.
So, the source material boils it down to this simple but incredibly powerful equation. If income requires a gain, and a gain is whatever you make above your basis, well, then the logic is pretty clear. If you have no gain, you have no taxable income, period.
Okay, now everybody buckle up, because this is where things get really, really interesting. This is where the source material takes these well-established legal ideas of basis and gain and applies them to something we all have: our labor. This right here is the big leap.
And this, of course, raises the fundamental question of this whole thing. If you need a basis to figure out if you even have a gain, then what in the world is your cost basis in your own time, your own skills, your own energy? Is it zero?
Well, to answer that, the source points to another huge Supreme Court case, this one even older, from 1873. And the court couldn't have been more clear. A man's labor is his property. The argument then follows: if your labor is property, then just like a bike or a house, it has to have a basis.
This slide just lays out the two competing worldviews perfectly. On one hand, you have the legal definition argued in the source: your labor is property, and your paycheck is just an equal exchange for that property, a one-for-one swap. But on the other hand, you have what the source calls the standard IRS presumption, that your labor has a basis of zero, which means every single dollar you earn is 100% pure taxable gain.
So let's say you accept this premise, that your labor is property, and it has a basis equal to the wages you receive. What do you do with that information? Well, the document we're examining doesn't just stop at the theory, it lays out a very specific strategy for how to act on it. The approach laid out is basically a two-pronged attack. First, you look backward. You correct the record for past tax years, recharacterizing your wages as a non-taxable equal exchange. Then, you look forward. You proactively put your employers on notice to change that default presumption for all your future pay.
Now, this entire strategy hinges on one critical legal concept: the rebuttable presumption. The source argues that when you get a W-2, it only creates a presumption that your pay was income. It's not set in stone. And like any presumption in the legal world, you have the right to challenge it, to rebut it with your own evidence.
Okay, now we have to talk about the elephant in the room. I'm sure you're thinking it. If this legal argument is so sound, why have so many people who tried it gotten hammered by the courts for making frivolous claims? The source material actually tackles this question head-on.
And what it does is draw a very sharp line in the sand between two different kinds of court cases. You have the foundational cases, the good ones, that establish that income absolutely must be a gain. But then you have the bad cases, where taxpayers just showed up and said, my wages aren't income, with no proof, no accounting, nothing. The source argues they failed on procedure, not because the core legal principle was wrong.
This chart really visualizes the core of the source's argument. The legal foundation, that Supreme Court precedent defining income as a gain, is rock solid. It's never been overturned. The rejections and penalties we hear about are, in this view, simply failures in application. People lost because they went about it the wrong way, not because the doctrine itself is flawed.
So this is the whole thing in a nutshell. It's all about the nuance. According to this analysis, the losing argument is that big, broad protest, wages aren't income. The potentially winning argument, the one based on the law, is a factual, accounting-based claim. Hey, income requires a gain, and my books and records right here show that this was an equal exchange. There was no gain. You see the difference? It's a shift from protesting to proving.
And so that leaves us with this final, really powerful question that gets to the very heart of this debate. Is the money you get for your work an automatic taxable gain from the very first dollar, or is it an equal exchange for your property, your labor? According to the legal analysis we've just walked through, how you answer that question, and more importantly, how you can document that answer, might just make all the difference in the world. Thanks for watching.